I know already without asking that several people have tried it and several people have not. So I can be disappointed and upset about that, but instead let's just move on. Okay, so what we're going to do is we're basically going to walk through this question and figure out what it is that we need to do. So part A says determine the tax issues for 2010 and include consideration of all activities and both alternatives. So what is it referring to? What are these alternatives that are being referred to? Anybody who's looked at the question, what are the alternatives, Michael?
The first one is leasing the building under a 20-year lease. And the second one is having the building actually owned by the corporation.
Okay, so this is lease versus buy of a new building. Okay, so it's a very straightforward question in terms of setup. We have a company owned by two people, controlled by one of them. And basically what we have to do is we have to go through and determine the tax issues. But really, so we could do that as a first step. I think what I'd rather do is just go straight to B and say to do Division B income under each alternative. So, ask yourself and then answer yourself, what does this mean? So when you see required, compute Division B income, we need to be at a place where we go, okay, I know what that is. I'm not wondering what I have to do. What do I have to do? Yeah.
I'm thinking that first you get like company income and then you add into the stuff to get your taxable income and then you minus Division C deductions to get it Division.
Okay, so let's take it in pieces. Okay, so first we have a reconciliation. Financial accounting to tax. What else to do Division B? What else did you say? Sorry, Peter?
Once you get your taxable incomes, I think you need to add back the Division C deductions.
Okay. So reconciliation and then Division C deductions. What else? Anything else I need to do? Zoe, what's on your mind?
Are you talking about Division B income only?
That's what I'm talking about, yeah.
Why is the Division C, why is it not?
Right, so let's make sure that we're clear about this. When I do, so this is just Socratic, right? I'm just letting you sit in your uncertainty. And now we'll resolve it, and everybody will feel good. We'll feel bad because we had the uncertainty and we were dead wrong about what Division B income means. So let's get this very clear. This is what we want to do for Division B income, the reconciliation. So our starting point will be financial accounting as long as the information is there. So let's see. Yep, it's there. Okay, so we know we're starting from a financial statement, net income. So we're going to reconcile, meaning we are going to answer a series of true-false questions about whether or not the thing that accounting did is okay with tax. Right? True, false. We're done. Right? That gets us down to something called income for tax. Or whatever you want to call it. It doesn't really have a real name. How does it work its way into Division B? So first of all, what is Division B income? Now this question does not ask us about these pesky ordering rules. Starting out with bad writing. This question does not ask us. Okay, so you should expect that the key to this question, the solution to this question, did not have any points for doing the ordering rules properly. But I want to bring them up because this will help you understand when you see Division B income, what we really mean are what? What's Division B income consist of?
This is property income and the tax income.
3A, business and property income. 3B. Did you say it, Jessica?
Class of capital gains
taxable capital gains and losses in the year. Yeah. 3C is a sum. 3B. 3D is what? Cody?
The non-capital losses and gains.
So losses. Okay, so we add all these things up, and this gives us division B. That's division B income. So we ask ourselves, so how does the reconciliation and the ordering all fit together? Well, they're really the same thing. And if I am given no command to do the ordering, then all I have to do is think about, okay, what did financial accounting do for it? Fix that, put in the tax, and I'm done. If I'm asked to do the ordering, it just means usually that, so the ordering rules cause us trouble in two places. First, it means you have to separate these things out. So financial accounting doesn't do this. Yeah, Amir.
I just have a question for section 3C. Why do we need a different section just for the summation? I mean, it seems for
We need it for its uses, right? So, for instance, we know when we need it when we go to calculate the non-capital loss for the year. That subtotal gets used and gets taken out from our net capital losses. So it's basically just we need it because the Act needs it in other places that we don't really understand, except for that one. So it's just let me answer that with just because. Did I ask a question before that? So the two places is the ordering rules are going to cause us problems. One is taxable capital gains need to be treated separately. Financial accounting treats them the same. That's what causes us trouble. So we need to separate them out. And then two, financial accounting, so this is sort of a second one, separate from everything up here. Right? Financial accounting says, you have gains and losses, you have profits in one business, losses in another, just bring it all together and there's one statement for the company as a whole, the entity as a whole. Tax says no. Keep your incomes and your losses separate within Division B. Again, for purposes that we need to know for carry forward and applicability of losses, because not all losses are the same, not all incomes are the same. We want to track things by source and by character. Okay, so that's Division B income. So where does Division C come in? Jessica. Right, so we go from Division B, and then we go to Division C, and we have things like losses of other years, we have donations, we have anything else? What's that? Dividends, flow through dividends. Okay, that's Division C, and so when we do that, we say division, so this will be plus or minus Division C, and that will get us down to what number?
Taxable income.
Taxable income. And now we're ready to go and calculate taxes paid. Okay, so we need to make sure we understand what we're asked for. And in this question, we are asked for Division B income, which means Division C, I don't ever mention it. If I do, I'm wasting time. Taxable income, not what I'm being asked. Now, understand that when I put something into Division B, it by default is ending up in taxable income unless Division C does something about that. But right now we're asked about Division B income. Okay, so we know that we need to do, so this is really our to-do. A reconciliation. Yeah, Jessica.
Question. So for business and property income, do we treat it differently when we're
Good question. Do we treat these differently? So they're both within 3A, right? So the ordering rules don't say what to do. So why do we have to treat them separately? Well, again, I don't want to overuse this answer, but the answer is really, it is just, for our purposes, is just because. We've met one reason so far that property and business need to be, so they're both non-capital. Remember, the big division is non-capital, net capital. Within non-capital, there's this division of business and property. So they're both non-capital things. What have we seen that it mattered?
acquisition of control.
On acquisition of control, what happens to property losses that does not happen to business losses?
They expire.
They expire. So we've met that one thing. That's one reason they need to be tracked. There's lots of other reasons, because property income goes by another name. Property income is considered to be
Non-active business income.
non-active or passive. So synonyms: property, passive, non-active. And so in Canada, we favor usually active business income over passive income. So it will matter, but so far not so much in our course. Okay, so you'll understand this distinction and why it matters a lot more as you go forward. But it's a great question because I know it confuses people. Does it matter? Because in the second midterm, right, you were separated out, given $7,000 of something on the acquisition of control, and you wondered, does this matter? And it doesn't, right? Property income and losses can offset any other kind of income. They just die on the losses die if not used. All right, so we have to do a reconciliation from financial accounting to tax. So if we must, we must. So net income per financial statements. Okay, so the net income per the financial statements, going back to the question, is given to us as $397,800. And so here we're told you have to do this. You have to do everything twice. One is under the lease option, and one is under the buy option. Okay, so we think that seems extreme, but it's really not that bad. So if I had a memory, $397,800, $397,800, $397,800. So this will be our lease, and this will be our buy. So really what we're doing is this question, if you want to ask what is this question about, what is it testing? At this point, not sure. It might be testing, do you know what goes into Division B income? But that's actually pretty easy. It does not look like a straight reconciliation question, right? So a reconciliation question that we're used to seeing, like we saw in the second midterm, would have that thing, and then it would have a ton of footnotes down here saying, buried in there are all these things that you need to think about. It doesn't have that. So this does not look like a straight up reconciliation question. So what is it then? Well, let's just, now look at that title. Can you guys read that? Somehow OneNote has decided that the title of our thing is Weenie. Now that's completely inappropriate. And the recording can't see that because it's cut off. But it must be thinking that's how bad my writing is. It takes the first word. It thinks my lease, it thinks I've written weenie. Note to self, be more careful. Okay, so we are not doing anything that has to do with a weenie. So can we do this reconciliation? So help. Because I'm already starting to wonder if I'm losing points. And I'm losing concentration. And I'm nervous. Michael.
Oh, you add attorney amortization.
Whew. Okay, so if there it is. There's a lifeboat, right? I know that depreciation needs to be added back. Whatever financial accounting did, I'm getting rid of it. So, So first of all, we know how reconciliations look. They have adjustments, or some people like to have the adds and the subtract separate. I'm not one of those people. So we have depreciation, and we're going to add back two numbers, 55,375. Wrong way. 55,375 and 61,000. So now let's change it to UECI. 61. It's guessing. It's gotten it closer to UECI. Okay, I'll stop talking about it. Okay, so 55,375 and 60. So all we're doing is saying, first of all, I'm not getting shut out on the question, right? I've earned at least a couple of check marks. Not getting zero, that's always nice. And so we're off to the races. Yeah, Jennifer.
Next, we also want to add back the charitable contribution.
Okay, so I want to add back these donations. Those are the same under the two options. So I'm going to add back charitable. Okay, and I'm going to just put them back. So as we go, now there are lots of ways to get to Rome. There's lots of ways to skin dead cats. So I'm not saying you need to do this, but I think, helpful, especially in the class. I don't know about the exam, but in the class, for us to think about, okay, let's look ahead. What am I going to do? So I know this was the easy part. Undoing what accounting does, that's easy. What am I going to do for tax, Zach?
So you know in the next step, if you're going to want to take CCA, and you're going to want to, if you're already in Division C here, you want to see if the charitable donations deduct.
Okay, so you covered both of them. So this will go to in Division C. So this is a good refresher. We're not getting the benefit of removing them from Division B income, but they will be removed from taxable income as a deduction, not a credit. On the personal side, we use credits for our charitable donations. On the corporate side, we use deductions. So that number will not make it to taxable income, but we don't care. We're doing Division B income. So we've just wasted time by writing this down, but it was very good to think about it and go, okay, I don't have to do anything I want to do with this. On the depreciation side, we are going to have to do CCA. So those three little letters look so innocent, but we know there's a ton of work to be done. Okay, so 3. What else, Jessica?
So there's entertainment expenses, and we can only take 50% of those. So
Okay.
it'll be 600 for both.
Okay, you're going to add back, so let's change it to horse. Okay, so meals, you want to add back 600 and add back 600. Okay, so let's look ahead. What's the tax going to be on that? What am I going to need to do for tax? I've already done it, right? So understand that with meals and entertainment, we treat them differently than most everything else we do. Most everything else we do is we completely undo financial accounting and then redo tax. Meals and entertainment, for whatever reason, we've all gotten to 50%, so we just do it in one fell swoop. But understand you're doing it differently, so it's done. Okay? You could add back all of them and deduct 600 if you wanted to, but that just is not the cultural norm at this point. Okay, so we're just cruising through here. We know nothing about cost of goods sold. This is a subtotal, so interest on Canadian Treasury bills. So what? Or you can say whatever you wanted to say.
Deduct the net gain.
You want to deduct the net gain. Okay. So what we have to be careful about here, so it's kind of exam thinking, we have to be careful about things that have footnotes. So that has a footnote there. And basically what that tells us is that's not one number. That's 1, 2, 3, 4, 5 numbers. So if you want to take that whole amount and treat it as one, you are by default saying those 5 numbers can be treated identically for my purpose, my current purpose. Is that okay with you? It's okay with Soy. Is it okay with anybody else? It's okay. We're building. The support is building. I feel like I'm about to go into a scene from Braveheart, so we'll stop and we'll say, okay, so what we need to look at is piece by piece. Gain on sale of land. Should that come out? Do we know that financial accounting and tax treat these things differently? Yes. Does gain on a machine? Yes. Loss on fixtures? Yes. Loss on store? Because we know that with gains, what does tax do? Right, so we have these inclusion rates, right? So we'll just note the half, right? There's that. And there's also the whole fact that there's UCC and recapture and all those things built in here. What about losses? How does financial accounting deal with losses? Yeah, Paul?
For depreciable items, we can't claim losses, so we won't be able to claim any of you won't be able to use it to set it against the gains on other assets.
Now, so did you just say on depreciable assets we can never have losses?
We can't claim
Oh, right. So these are never capital, right? Not capital losses for tax. So tax, that's a good point, right? We never have a capital loss, but we could have what's called a terminal loss. Or we could have recapture. The point being, tax does it differently. So what we want to do is get rid of whatever financial accounting did. So whatever numbers financial accounting came up with, get rid of them. And we can do that in one fell swoop. But understand, that's what we're doing. One fell swoop, boom, gone. Okay, so we will add back. Or sorry, actually in this case we're deducting. So the net gains have to be subtracted, and they are 278,150, 278,150, 278,150. Okay, so now, what does tax do with these things? Well, we just talked about it, right? We have taxable capital gains, we have terminal losses, we have recapture. So let's go back to the question. We can put a tick mark there. What about interest on Canadian Treasury bills? It's the only non-subtotal, well, except for cost of goods sold, that does not have a check mark. So what do we do about interest? Okay.
It's property income, so it's okay.
So it's absolutely, so it does not need to be added back. And even if we were asked for the ordering rules, technically this is a sub piece of 3A. So to be really careful, we would want to have business, and then we would want to separate this out. We're not asked for it here, so I think it's a non-issue. Okay, but we do, possibly we want to have it separated as, so we want to do business and then property, then this piece would come out. But that's not what we've been asked to do in this question. Okay, so we can ignore it. So we've hit all of these things. Then we go and we say they give us a balance sheet. So they give us a balance sheet. Is there anything on this balance sheet that is likely relevant to reconciling financial accounting income to income for tax? Does anybody see anything? Yeah. All right. Oh no. So nothing. Why on earth did they give it to us? Because this is an old exam question. Pretty sure, almost positive. This is an exam question from 2010, so you'll see it, and you'll see a full solution to it, so you can correct all the errors that we're making right now. So why did they give us that? Yeah, Allie.
Well, I can help with the CCA calculation because it has costs.
Okay, we might need to come down here for costs, so possibly costs for disposed assets. Okay, anything else? So the answer is no. There's no information for what we need to do. Okay, so there is some there. So stated net of accumulated depreciation. What that tells us is they've taken the cost and taken out what accounting did. So this is not a useful number to us. Those are not useful numbers to us. Okay, so it's sort of there, I think. I don't know. I didn't write the question, but I think it's there to test the students to see if they know that it's not useful. Yeah, to allow.
So would any additions be given in footnotes, or would they be given?
Well, so we'll see. Yeah, we would want to come here and say, okay, so I see assets here, right? So I see equipments and fixtures, and I see in 2009 I had 133. They're saying that I have, so clearly I have added assets, but I don't have the information here to know what those were. So we better be getting some information up here, and we do. Okay, so when you look at this and you look at the current state of things, you say, okay, I know I need to get down to Division B, and I know what I need to do, right? I need to do a bunch of CCA calculations, and I need to do that. So what's this question really about? I mean, what is the separating knowledge sector for this question? Yeah.
Is that special rule we looked at where it had the land and building sold together? That's one of the things they talked about.
There's one of those, but I would argue that this question is really about, broadly, capital assets. Right? All we have to do to finish our question, to answer what we've been asked, is do CCA calculations and deal with assets that got disposed. That's it. Yeah.
Just a question, in terms of the case stocks, they seem to be leaning towards those capital assets. So essentially, is that what we're looking for in the therapy questions?
Yeah, absolutely. Look at this. I mean, so when we go back, because we haven't even read the question, but if we read the question, we can see that what they're going to tell us about are fixed asset transactions. They're going to tell us as a sub piece of that, acquisitions and dispositions. That's the whole question. Okay? So, what we need to do then, once we've identified this and said, okay, to answer the question, I just need to do CCA. And so what I need, I think, is a good list of the assets. If I don't miss an asset, the likelihood of me missing large numbers of points is lower. So let's try to make a list of the assets by looking at the question. Okay, and before we do that, let's just remind ourselves what buckets. Okay, why don't we actually draw buckets? I don't even know how many there are, but we'll start with 3. What kinds of assets, for the purposes of CCA and otherwise, can there be? So what kind of assets do we calculate CCA on? Yeah. Depreciable. Okay, so let's assume this is all. So we'll have non-depreciable over here. Let's just have it separated. So we'll have land, and then we'll have depreciable. So all of these buckets are about depreciable. Okay, so how do I bucket these things? Which ones do I calculate CCA on? Mary?
Stuff except for that.
What's that?
Stuff except
Right. So all of the, well, is that true though? Right? So I don't calculate CCA, so you don't know what I'm doing, so I'm not being very good about it. So how about we have this? On hand all year, purchased in year, sold or disposed in year. Is there any other kind? I don't think so, right? So we had it all year. We had a part of the year, the first part, and we had it part of the year, the second part. Those are really the kinds of assets. So which of these do we calculate CCA on? Whoops, sorry. Oh, hi, Adeline. Which of these do we calculate CCA on? Yeah, Dylan.
So anything that had a balance at year end, so the on hand and the purchase in the second half.
Yeah. Okay. Which of these could possibly have generated taxable capital gains? Alan. The disposed only. Which of these could have possibly triggered recapture or terminal loss? Disposed. Right? So when we look at this, we say it's not as complicated as we sometimes make it out to be. There's going to be some assets that are going to be really simple. We had them at the beginning of the year. They had a beginning UCC balance. We calculate CCA, we're done. Others we're going to purchase in the year, so that's going to bring in the half-year rule. Okay. What we need to understand, though, is that these are really in a kind of overall bucket. So they're sub-buckets within a bucket. And because I think maybe through the questions that we've done, and I've had enough questions from students who I think you all sort of think if an asset is sold, if any asset is ever sold, there has to be terminal loss or recapture. And that is not true, right? So there's a question on the midterm exam, when is there a terminal loss? The class has to be empty. And I think what happens is, meaning you do not own an asset in that class. I think what happens is we do so many questions where each asset is its own class that you start to think, well, to sell an asset, it has to have terminal loss or recapture. It doesn't. And so we'll see that in this question. But just important to note that not everything, this is sort of only, these are special. Empty class. And then what's recapture? Do I have to not own any more assets? Alex? Negative UCC at year end. Okay, so my UCC balance technically can be negative while I'm doing my juggling around, but if it's negative at year end, then I have recapture. Okay, so those are the conditions. End of little sermon. Yep, Jessica.
Doesn't have to be empty for recapture.
Does not. Okay, so let's list our assets. So let's go to the question for this and do some reading. So we haven't done this, and this is absolutely valuable. I told you the TAs are going to record, and I tell you probably the most valuable thing, Andrew's done the first question. I think he's done a great job of walking through the question. He's actually using Word and showing you, like he's highlighting and putting comments. I see this tells me that I'm probably going to have to do an acquisition control. I see this, it tells me this. So it's very valuable stuff. So let's go through here. We've got a bunch of preamble here that tells us about this company. This is our taxpayer. Just in case we always want to know what taxpayer we're accounting for or dealing with, but that's usually not confusing in the questions that we give you. And then we have this issue where they tell us about so they tell us who owns the company. So let's just get this down, and we have, so this company is Custom Tops Limited, Mindy, I won't bother drawing the stick people, and Randy own 2/3 and 1/3 of the company. Okay, so that's basically what we pick up from the first one. We know that one of them's active, one of them's not. All of these things matter, but not to us. Okay, the fact that he's not active, that causes him tax issues, but not for us. We're counting for the company, not him. Okay, the fact that we don't know anything about their relationship, and we don't need to infer anything. By what did you hear? Okay, so anyway, we don't need to infer anything. So it comes on, it says, okay, here's what we're going to do. So you want to come to these things, obviously, as a student first. I wish it weren't so, but it's so let's acknowledge it. You're coming as a student first. And you say to yourself, okay, if somebody is going to put a heading, they clearly want me to think about that thing. But they may want me to think about it in such a way as to actively ignore it. And so be very careful about saying information must be given for a reason. That reason could be to see whether you know whether the information matters or not. Okay, so let's look at this one. During the year, no changes in ownership occur. Oh, phew. Right, no acquisition of control. Flip to the other questions on the exam. Oh, dang it, question 4. I hate you. That was not a tip. I am like a vault. You will not get anything out of me about what's on the exam. So if you think I'm tipping you off, I am not. Okay, please, that was awful because now you're all thinking, oh, question 4 is acquisition of control. It's actually question 2. Okay, so during the year, no changes in ownership occur. So no acquisition of control. The corporation paid dividends of 50. So they paid $150,000 in dividend. Now, we know that financial accounting does not put dividends on income statements. Right? We know that. The question is this a reconciling item? Is this something that we have to do for tax that was not done for accounting? Code.
Not because it's after tax.
Right. So we do not fall into this trap. Right? These are after-tax dollars. And so dividends in Canada are not deductible by the company and are not, end of story. They're taxable in the hands of those people with the integration system, blah, blah, blah. But for the company, our taxpayer, these are a non-issue. They're done out of after-tax dollars, and so they do not affect Division B income. They do not affect taxable income. They are not dealt with in Division C. They just are nothing. They never are talked about or entered. Okay. So the next heading is fixed asset transactions. So remember, our quest right now is to come up with a list of assets. So we don't want to get bogged down in the details. We first just want a list of assets. So we read, to make a home for the new store in 2007, 3 years ago, Randy decided that the business could use a house that he owned. So this is one of the owners owns a house and says, my business, which I own 1/3 of, could use it. So what they do is they say the house was rented, the house had been acquired, so we have a cost of $40 when the land was $250, and the building was $150. That's $1999. So he bought it in 1999 for $400,000. In 2007, when he transfers it to the company, the values are 400, which matches. Oh, sorry, no, it doesn't match. 400 for the land, and 125. Store began operating. Okay, so the rest of this is other stuff. So this is land and building. Okay, so before we're not going to get bogged down on this. We are just looking for a list of assets. So our list starts with land and building, and we'll do them. You can do them separately if you want, but let's note this is old or existing or however you want to do it. They had this at the beginning of 2010. Okay, and we will come back to it, I promise. But for now, we've just found the asset. Now we read on. The store began operations on September 2000 and placed into service at that time store improvements. So now what we have is we have them improving the building. So are improvements their own asset? Are they expensed right away? What does financial accounting do with an improvement? What do they call it? Yeah, Julian.
It's on your class 13 where you take it out, you divide it over the number of years of lease plus the first.
Oh, okay. So what you're talking about here is this a leasehold? Whoa. So let's get this. Is this a leasehold improvement? And the answer is no. This is not a leasehold. Why? Because we own it. Okay, so your answer is perfect for when I improve an asset that I lease. This is what do I do when I improve an asset that I own?
Add it to the same property.
So financial accounting says you add, it's a betterment, not a repair. And so you add it, tax says the same thing. If you improve an asset, this goes to the cost base. So this added to the cost. So the true cost of this thing is $30,000 higher because of this improvement. Okay? So you can track this, but instead what we want to do is probably just note here plus improvements. Okay? You can list it as its own asset, but you're just going to need to make sure that when it comes time to get rid of that building, it goes with it. It's not severable, obviously, from the building. Okay, so then we read on, and it tells us that store fixtures, I don't want to know anymore. Store fixtures, I will list as our second asset. So these were purchased in 2007, so they are definitely on hand when we start 2010. A computer. Full stop. 3, computer. Also old. And then I have an embroidery machine. Which also, so I mean, you could also put, instead of old, if you don't like the word old, just put 2007. This is when this thing came around. But basically what it tells me is it's there at the beginning of 2010. So then it gives us some information about these assets, which we are just on a quest to learn to list them. So we're going to skip this for now. We will need this information, but for now we're skipping it because we just want to know what assets are in play. So then we read on and we say in February of this year, a salesperson convinced the owners to replace, oh no, please no, not the replacement property rules, their embroidery machine with the latest version. Okay, so the word replace, are these replacement property rules? Tian?
No.
Why not?
Because the replacement property rule only goes for involuntary disposition and normal business property.
But the salesperson convinced them. You know how convincing those salespeople can be? I was walking through the mall yesterday, and this woman, it's going to sound like a good story so far, this woman grabbed me and said, you know, do you have a wife? And I said, yes, I do. And she said, okay, well, she's going to love this. And she proceeded to show me this. It's called Secret. I'm sure you've maybe seen it in the mall. So she polished my nail, and, you know, you got to buy this for your wife. And she was very, very aggressive in her sales pitch and talking so fast. And I can't remember why I started this story. Oh, because I think there'd be a lot of people that would be just convinced. It's like, okay, I have to buy from this woman. I, on the other hand, was like, I can see through entirely what you're doing, and I feel terrible for you. I do feel terrible that you have to sell this, but I'm not buying it from you tonight. Anyway, because what she did was, I shouldn't be doing this, but she put the boxes in my hand. So you salespeople, you know all about this tactic. She put them in my hand. And I'm like, I will put these down in that wishing well. You need to take them from me. But she was literally like, you hold it. Very, very textbook. But she talked so fast I couldn't understand a word she said. Anyway. Yes, the point is, no matter how convincing, these have to be an involuntary destruction or expropriation. Okay, so remember, cheat sheet, go to it and say, replacement property rules, that's pretty specific. The only time I have to wonder if it's okay when it's voluntary is when it's land and building, specifically being replaced. But so the word replace did not throw us off. But what it tells us is they now have a new machine. So we have a new asset. 5. Machine. New. Okay, so we read about that. Then, August 30th, 31st, 2010, the corporation entered an agreement to sell its land and building. Okay, so we already have met these, so these do not go on our list. They're already on our list. A new building. A new building is to be acquired. So here's our lease versus buy. So what we have is we have this new building, and we kind of asterisk it because this is kind of the second big point of the question. If they go lease or they go buy. So if they don't ever buy this thing, clearly we're not going to take CCA on it. If they do buy it, we will take CCA. Okay, and then it goes on. It says the business ordered some store. Oh boy, so there's some store fixtures that are new. So we have fixtures that are new in order to modernize, and they threw out the old ones, and that's it. Okay, so we think we've read every word in the question so far. We can go down to the balance sheet and see, is there anything there that we did not account for that's a depreciable property? And I don't think so. Okay, so now we want to remind ourselves that what we're really doing is preparing a reconciliation. So what we're really doing is we want to come up with a CCA number. That will be one number, which will be the amalgamation of a whole bunch of numbers. So from an exam writing point of view, we have to look at our watch and say, okay, am I going to be able to do all of the assets that need CCA calculated on them? Who knows? Then I look and the taxable capital gains, I need to know what was disposed. So let's go through quickly and see if we remember enough from the question. So this was disposed. Fixtures were disposed. The computer is on hand. The machine was disposed. The new machine was acquired. The new building, if it is acquired, is acquired. And the new fixtures are acquired. Okay, so what I know is that these will contribute to CCA. So I can go through and just do a little CCA, 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 and CCA. And then we have to note here that we have some class overlap. So this is the point, and possibly here, do we have a class overlap? So this is the point of in buildings. So in general, just in general, think of buildings as their own class. There are very few buildings that don't go into their own classes anymore. So think about it that way. But these fixtures are all going to be one class. So this goes back to the point that I made before. These ones won't, I mean, they could have a terminal loss, but not likely because we know that that asset class is not going to be empty at the end of the year. So I can kind of know that there's not going to be a terminal loss. No matter what happens, there's going to be assets in the class. Okay, but since we have the time, we will do CCA for everything that needs CCA. Okay, so let's do that here. So CCA. So let's start with the easy one, the computer. The computer, the question tells us that the computer is in class 45. Okay, we don't question that. So class 45 starts the year at 1172. So UCC start is 1172. So, but let's not let the question tell us what else goes on a CCA schedule. Let's prepare the left-hand side of our CCA schedule. What should be the next line on a CCA schedule? After this is opening. What's the next line? Yeah, Alan. Additions. Okay, what's the next line? Sam.
Dispositions.
Dispositions. What is a next line? Jessica.
Net, addition, disposition.
Net. Okay. This is important. Okay, then next after that, half year rule. Okay, so and now this is, I use half out. You can do whatever you want. Something to do with the half year rule. What comes next then? Ken? CCA. Okay, I would. It's fine if you can do it in your head. I would think we would want to do what I think we captioned this way: UCC for CCA. Okay, and then we'll have our rate here, and we'll have calculate our CCA, right? Because we want to be able to apply a rate to one number. Then what comes next? Talal. Half in. Then what comes next? Yeah, Gloria. UCC end. Okay, so that's good. I think we're pretty good. So the question is for this computer, which is on hand. There were no additions to the class because we've met every asset and no new computers arrived. So this is 0, this is 0, this is 0, this is 0, this is 1172. And what's the rate for class 45? It is, tell me again? 45%. Yeah, it matches. I forgot. 45%. And that is 527. Now, how do we put the half year? Well, half back in is 0. What's the ending UCC? Alex? 645. Okay? And this, my friends, was a what? It goes by the technical term in the Income Tax Act of a waste of time. Right? So we understand that what we are calculating, what we need is CCA. And so unless somebody asks us for ending UCC, we waste our time by doing that extra calculation. So again, we can be more efficient by trusting ourselves that where we can stop. Now, are you safer to say I'm just going to do the whole thing because I don't have the confidence? Maybe, but if you're asked for CCA, don't bother going to ending UCC. Okay, so that's one asset down. We are cruising. So let's go. Big check mark. What do you want to do next? Well, there seems to be overwhelming support for doing the fixtures, so let's do those next. Okay, I'm doing them, people. Please. Okay, fixtures. So this is class 8. And they kind of gum up class 8 in this question. So let's just make sure we understand this. So class 8, they have told us that they are putting the store fixtures in class 8. That makes sense. They have also put that old machine in class 8. Okay? Which, class 8 is sort of the catch-all, but one would not expect a machine to be in class 8. But anyway, that's where it is. So the question is, does this mean the new machine should go there too? So if somebody has made this machine A is being replaced by machine B. Machine A was put in UCC class 8. Are we somehow bound to use class 8 for machine B? Jennifer? We're not, right? So we make the right call now. If we came along and said, what is that machine doing in class 8? We would come back and we'd say, get it out of class 8, get it into the right class. Okay, but so for now it's in there and we're not going to undo all that they've done. And so our beginning balance is 141,120. 141,120. Are there additions in the year? And there are. We met these new fixtures. So what amount goes in to a UCC class? Before we look at the question, what amount are we looking for? Go.
Capital cost.
The capital cost, right? And so for the most part, that's what we paid. So what did we pay? And I'll tip you off, it's the very last sentence of the question. We paid $20,000. Okay, so our additions are $20,000. We are not going to put the new machine in here. Okay, we will put the new machine in its own class where it belongs. What are the dispositions from this class? So we have to go back here. So first of all, what are we looking for in terms of what number will go on a CCA schedule for a disposition? Alex?
Lower of capital cost.
Right. Okay, so I don't want to gum up this schedule too much, but let's just remind ourselves here. We'll just put it for all to see. Lower of cost and proceeds. That's what leaves a class when we sell an asset. So, what did we sell? It tells us that the old store fixtures, which are in our beginning balance, will be replaced with the new one. Oh, there's that word replaced, but we're not going to walk down that road again. The old ones will be taken to the local dump at a cost of $100. So what's the lower of our cost and proceeds? So the cost is 15. What is the proceeds? What are the proceeds? Umair? Negative 100, right? So it's actually costing you to get rid of them. This is much more real world than the stuff we usually look at, right? Most things that you're done with, nobody else wants them either. And so you have to pay someone else to get rid of them. And so you have a negative 100. So what do we do on the CCA schedule when it costs us to get rid of something? Well, we add. So this is negative 100, but because we put disposition, we're taking that out of the class. It's a double negative. Okay, so there's 100. We also have this, again, this is complicating because of how they treated it before. This machine gets sold. So let's go back to this and say this machine gets disposed. And it's in class 8. So we need to find the lower of cost and proceeds on this thing. So we go back to the question and we see what we can find. The embroidery machine's cost was $210. So keep that in your head, $210, or write it down somewhere. $210 is the cost. What are the proceeds? Dylan.
So you want to look at the discount that you get when you trade in that old machine, when you're purchasing the new one.
Okay.
So you take the difference between what the regular retail price of that new machine would be, less the amount you actually paid. So it would be $100,000.
Okay, so this is, so basically you get a new machine that's worth $250 and you hand them $150 in cash and a machine. So that's the same, in substance, exactly the same as if you handed them $250 and the machine and they gave you $100 for the machine. So our proceeds are $100, and so the lower of $100 and $210 is, anybody have a calculator? $100,000, one of my best jokes, I think. So that comes out of the class. So what is our net number? So this line that we have net, are we adding up all of these numbers, or are we adding up just here? We are adding up just here. Well, that gets us to minus 79.9. So what do you do when your net additions are negative? We've never seen this before. Sounds like a terminal loss, right? So we have a terminal loss. No. So what do you do when your net additions are net? It feels like a terminal loss. It's not. It has to be set to 0. Basically says you didn't add anything in the year. You lost. But so your additions, your net additions are 0. Okay? So, which is nice because then we don't have to hold anything out. So this $20,000 looks like it's not subject to the half-year rule. Right? Technically, all of that 20 is getting added to and getting to be depreciated this year. Okay, so the UCC for CCA then is 61,220. The rate for Class 8 is 20%, which gives us 12,244. And we're not going to fall in the trap of going further down. Michael.
I have a question.
Yeah.
How did you get 61,220 if that's 0?
Okay, so 61,220, unless my math is wrong, is A plus B minus plus, right? It's the sum of those numbers. Okay, so
why don't we do the CCA on the remaining?
why don't we do what? We take CCA on this number.
We take CCA on 61,220.
Yep.
Oh, okay.
Yeah.
Sorry.
Okay, so we are just making great time. So we've done the fixtures, we've done the old machine, we've done the computer. So we just have to do the new building and the new machine. And then, of course, this beast up here. Okay, so the new building, why don't we do that first? Building. Okay, it's a new asset class because it's a new building. So this is hypothetical. If we buy it, the additions will be 225. The dispositions of that class will be none. The net additions will be 225. The half year out will be 112,500. The UCC for CCA will be 112,500. This will be a class 1 non-residential, so that will be 6%. And that will be that's the wrong one. 6750. Okay, so that's a straightforward one asset per class being added, and we'll do one more of those for good measure. The machine is going to go to class 29, which is manufacturing, and it's the straight line. You get 50%. So additions are 0, 250, 0, 125. Oh, sorry. Sorry. 250, 125. So, by the way, if I'm in an exam, there's no way I'm writing down these numbers. Just so you know. And then this is a 50% sort of straight line deal, but we'll call it that's 62.5. Okay? So there's our CCA numbers. We did it, I think. Let's make sure we did. Is there anything else that might have had CCA on it? So that's the new machine, That's the new building. So this gets disposed in the year. This land and building gets disposed. So we know that in the year of disposition, so we know there's no CCA on the land. On the building, we know that in the year of disposition, if the asset class is going to be empty, there will not be any CCA from that building. So we know we're done our CCA. So we can either, we'll do it this way. We'll say, here is what we need to do. We need to take these numbers and add them up for the lease option. Because if we don't buy the building, we will not be able to deduct those things. And then the sum of all of them will be the buy option. And that will be 82021. Okay, so let me just fill those in so our schedule looks more complete. So here we go. 5 CCA under the lease option is 75271, and under the buy option is 82021. So we're almost there. But what we have to do now is say, okay, we've dealt with these assets that got disposed, and none of them have been disposed at above their fair market value. So we haven't had to worry about capital gains. But this guy causes us some problems. So we know that the land is not going to flow through CCA, so we're going to ignore that for a second. But this old building, so we'll do it in purple just because that's the pen I have. The old building, we are told, is in class 1. And has a starting UCC of 158,054. So what we know, tell me a number on my schedule that I know, knowing that this building is gone, sold at the end of the year. If a building is gone, then I know my UCC is 0 at the end of the year. The question is, what comes out? So there's no additions to the thing. So what comes out is right now, the question is telling us that this person, they're going to sell their land and they're going to get $700 for the land and $100 for the building. So a total of $800,000. So what that tells us is that the lower of costs and proceeds is $100,000. Okay, so because the cost was much higher, it was in the twos. So that tells me then that my net additions are minus, so basically set to 0, and then I have, take that out, and I'm left with, instead of a 0 number here, I'm left with 58,054. So I have a positive balance and a empty class. That's a recipe for terminal loss. Okay? So I come back up to my reconciliation and I say terminal loss on the building, and I say Jackie has a point.
Is there like any no terminal losses?
Right. So there are in fact a no terminal loss rule. Denied by 1321. So don't spout these sections. I just put it there so it'll ring a bell. This basically says basket sale of land and building. Because these things are usually not severable, right? The land and the building are really one, even though people will say I want $700 for the land. So can't do that. So what we need to do is deny the terminal loss. So what that means is we need to come up with, so 1321.1 says, come up with proceeds of disposition on the land so that you don't have a terminal loss. So we've seen this before, and we already know what the answer is going to be. We know that those proceeds have to be equal to the starting UCC, so that what comes out of the class will be the mirror, the negative of it, and so the class will have a 0 balance. Unfortunately, the Act says, even though you know the answer, do this ridiculous calculation. So here's the calculation to remind ourselves one more time. These are what cheat sheets are for. So the proceeds of disposition are equal to the lesser of two things. One of those being the fair market value of both things minus the lesser of two things. ACB of the land and the fair market value of the land. Okay, so that's one piece of our lesser of, our upper lesser of. The other piece of the lesser of is, of course, a greater of. Two things. The fair market value of the building and the lesser of, one, the capital cost of the building and the UCC of the building. Okay, so this is just the Income Tax Act showing off. Saying, I can make you do a whole bunch of things even though you know the answer, which is not true. It does come out the other way sometimes, but not in our world. So we just have to go and fill these in. So this is 158. This is 100. That's not true. This is 180. Sorry. 180 is the cost. And the fair market value that they're assigning to it is 100. The ACB of the land is 250. And the fair market value is 700. And overall is 800. So, yeah, Umar.
Are all 6 questions of the exam like this one?
They're all about 3 times as long as this question. Okay. So no, the exam. No. So let's go back to the lesser of. So what's the lesser of these two numbers? It's the 158. What's the greater of these two numbers? It's the 158. So 158,054 is our option for 2. 800 minus the lesser of these two things is 550. So our option for this one is 550. The lesser of those two is this one. And just like we knew it was going to happen, those are the proceeds on the building. But this is not in vain. So let me just finish this, okay? This is not in vain, because what comes out of this is these are the proceeds on the building. What then are the proceeds on the land? Jennifer. 800, the full sale price minus what's been taken up by the building. And so this ends up being 641,946. That's the proceeds. Now I know the cost of the land from the question is 250. So I know my capital gain is 391,946. I know that I multiply that by a half to get my taxable capital gain of 195,973. And this is the number that I need for 3B, for my reconciliation. So the sweet thing is that I have got my taxable capital gain. And under this option, it is, I have it right here, 195,973. 195,973. Okay, so the only thing that we, so really we're done, right? These are our Division B incomes. Add those up, and if I did it right, I don't know if my numbers match or not, I get this, and I get this. Tian, you had a question.
Oh, I'm wondering why the ACB of the land does not get affected by the change of leasing property.
Okay, going back to the question. Okay, we'll finish with this. So this is a good question, and it's given to us. So I think what you're asking is, in the question it tells us that this guy bought it for $400 back in 1999. It then was transferred in 2007 when the values were different. So that's what this note is about. And thank you for raising this, because I did want to talk about this. So for tax purposes, the land and building are acquired by custom tops at the previous tax values. So this is stuff that you will learn in your next tax class. I'm not sure. Might be in the MAC. I can't remember. But when an owner transfers something into a business, tax has a lot to say about that. But at the end of the day, what this is saying us is you don't know that. So what you need to do is just use those oldest cost numbers. We have had a question. I don't know if it ended up getting answered yet on the discussion board. So I really want to make sure everybody understands what this is. What are tax values? What are tax values? When we say the previous tax values, what are tax values? I know we're in borrowed time here, and actually I think there might be a class in here. So this is UCC, ACB, and capital cost. Okay, and these are almost always the same, I understand, but so just think of it as UCC and cost. That when someone says what are the tax values of an asset, that's what they mean. What's its UCC? What's its cost? Questions?
So then, if we looked at the balance sheet, we're supposed to ignore those numbers that when they put it in, that cost for accounting purposes, because it's saying for tax purposes there.
Yeah, now I'm not positive you needed to ignore this, so you think there's information
Well,
here?
I didn't really know what they meant by that sentence that we just talked about, so I just looked on the balance sheet and then took the accumulated depreciation and added it back, and so they put it in at 125.
Okay.
But then that's for accounting purposes, so I guess that was not really what I meant.
Yeah, I think it might not have been. Oh, no, yes, I know that it wasn't. Yeah, we need to take this note and heat it right here and say pick up the whatever it was. It was $250 for the land and $150 for the building. And then the building has this extra 30 of improvement. Okay, so I've kept you long. Yeah.